All right, so this is from Meb Faber that says this indicator just flashed red, and I'm such a big fan of Meb. I don't listen to his podcast anymore. I just don't have time to listen to investing podcasts, but I like Meb. His podcast is fantastic. So if you're this stuff just bores me, and when I say it bores me, is because there's no way to skin a cat. The way to skin the cat is pretty tried and true. However, there are things you can do to position yourself if the market does turn red, as Meb is implying here. And I agree with what I'm saying. But anyway, Meb, great guy. I've never met him, but I've enjoyed his work for many, many moons. And you should follow Meb over at Cambria. We'll get to it here. All right, so when the facts change, I change my mind, as a quote we attribute to John Maynard Keynes. And then he says also, but what do you do exactly? All right, the two primary pillars at which Cambria builds our portfolio are on value and trend. 100%. I could not agree more. So value, you want to buy stuff at a discount relative to PE ratios, relative to cash flow, all that stuff, all the metrics. 100%. I agree with that explicitly. Trend is a little bit different take. Trend is saying, look, if the trend is going this way, I would say you ride your winners, you cut your losses. 100%. Cut your losers, ride your winners, you're following the trend. And there's lots of evidence that trend dictates performance more so than even valuations, at least in the short term. But I think the evidence is quite overwhelming there. But sometimes value and trend line up together. Low valuations, and they start to trend upward. That's a good place to be, which is an inexpensive investment in an uptrend, 100%. But many times they disagree, and that's been the case for some time in the S&P 500. We have actually the S&P 500 become more and more expensive relative to earnings, and yet the trend is going up. So you're like, oh, it's getting more risky relative to PE ratios and expense. The dollars you pay for a dollar of earnings, the price you pay for a dollar of earnings, and yet the trend's still going up that way. So you're like, walking on thin ice. But then he says the next quadrant, expensive in a downturn, is a full-on bright red light flashing that you cannot ignore. When the market sours and it enters expensive downturn conditions, gains that accrued over the last quarters and years can evaporate quickly. Yep. Historically speaking, markets have performed poorly when it's in a downtrend. Trend has officially now gone from up to down, and this suggests investors need to think how they're positioned. Yep, exactly. And what he does to measure the trend, he looks at the 200-day moving average. Now, I don't like the technical analysis stuff, but I think it's interesting nonetheless, because I do think there is something about trends and momentum. All right, so here, the 200-day analysis, you right there. So here's a trend in that blue, and you can see here's the price of stock, S&P 500. All right. So the S&P 500 went below the 200-day analysis right here. The trend line went below the trend line there and touched it there, a little bit below there, and then right here. So I have 1, 2, 3, 4, 5, well, 4 in the past. Of the 4 times in the past, so the S&P 500 went below the trend line, that was a bad bet, because right here, you would have gotten out. Right here, you would have gotten out. Right there, you would have gotten out. Right there, you would have gotten out, and you would have missed this huge gain. So let's just see what this chart looks like. S&P 500. Remember, this is just price to price. Doesn't include dividends. So right there, the S&P 500 is trading at. Well, that's not the price. I'm not even sure what that is actually. That's not. I don't know what this is right here. It's not the price of the S&P 500. It's not 8,900. Anyway, but it is weird. I'm not sure what that is. But anyway, you would miss this huge run nonetheless. So you got to be careful on the trend momentum thing. However, let's just take a look at here we are now. We're way up here, way up there. I don't think anyone's going to sit there and say the S&P 500 is fairly valued. I don't even think Jeremy Siegel is saying that. So you can see we're significantly higher than where we were. And again, the boots on the ground things have changed significantly given a war. Given the supply chains, the price, the whole thing's just completely kaput where it was, just pre-COVID. It's just crazy, man. So when the facts change, I change my mind, 100%. Now, there's no guarantee that the market's about to implode, says Meb. But the trend indicators have experienced many whipsaws and head fakes over the past decades, we just saw. All right. But what can you do? Well, you can invest in a couple of things. Right here, he talks about the CAPE, right? So he says like cyclically adjusted PE ratios. And I challenged the CAPE many times. I've done 1,000 videos on it. It doesn't take into consideration the alternative investments, which are the 10-year Treasury bonds. And if you can't invest in a 10-year Treasury at more than, what's it doing right now? Yeah, 1.85. It's still not 2%. Historically, it's been 5 to 5.5. You got to look at the inverted PE ratio of the 10-year Treasury relative to what you're paying right now in the market. And the facts are the bonds just aren't very attractive, which means the prices, the PE ratios are going to be elevated because of the alternative investment is even lower than the PE ratios. So while that is, high relative to future or past price to earnings ratio, it's not high relative to current bond rates. I hope that makes sense. All right. So what does this mean in practical, applicable terms? All right. First, you don't have to invest 100% in stocks, 100%. We often say the best way to hedge a risk is not to take the risk in the first place. No one says your entire portfolio needs to be in equities. It could be 80 or 60%, even less. You don't have to limit yourself to only U.S. markets. I disagree with that fundamentally. Meb is a big fan of international markets, and he says it's a no-brainer. I think it's a no-brainer to not be in international markets, that's for sure. You could add liquid alternatives. Think real assets like commodities and real estate. Well, I have real estate. It's my house. And I do own some commodities. I own gold and silver, and you should too. And not ETFs, not funds or stocks that trade in gold and silver, the actual coinage, the bullion. Let's see. Incorporating strategies like trend following and managed futures. I don't want to do all that. But most investors, but there's another thing right here. And he says we can buy puts against the markets and go long in government bonds. I think this is a great idea. So he uses his tail, which invests a ladder of puts on the U.S. stock market paired with long positions in government bonds. What is a put? A put is if the markets go down, you put the lower price of the markets to your investor, if that makes sense. I'm putting it to you. A call means I'm calling it from you. So again, if a call says, I'm going to buy, so let me just explain how this works. A call says, I'm going to buy an option that I can buy these shares from you at a strike price. So let's say the stock is trading at 30. I'm going to buy an option that says I can buy it over the next 6 months at 35 from you. Regardless of what the stock does, I will buy it at 35 from you if I want. I will pay you $100 for that right to do so. Hope that makes sense. And so the guy says, okay. The guy on the sales side says, I don't think the stock is going to go to 35. I get to keep the dividends on top of that. And if it does go to 35, I'm still $5 ahead of where I am today because right now it's trading at 30. So for me, I know I will have the option price, which is $100. I know if I get it called from me, I will get 35 from you, and right now it's only trading at 30. All right, and on top of that, I get to keep any dividends that come in. So so the seller of the call option says, yeah, I'll take that. The buyer of the call option though says, yeah, because I think it's not going to be 35. I think I can get it at 35, but it'll be trading at 50. See what I'm saying? So the only risk the buyer of the call is what he loses in the premium to buy the call. He's paying $100 for that right to buy your shares at 35. If the shares don't go to 35, he loses his premium, the $100. If the shares go above 35, well, he's what's called in the money. So if the shares go to 38, he buys it from you at 35, and then he either sells it at 38, which he pockets that $3 per share, or he keeps the shares, whatever he wants to do. And that's a call option. I get to call away from you your shares. A put option is the exact opposite. It says, I'm going to put the shares to you because they're less valuable today than what you said you'd buy them from me at. So now we got a $30 share, and you're going to buy a put. All right, I'll say, I will pay you money to buy my stock at 25. I will put it to you at 25. And if the stock goes to 10, I save my bacon. You have to pay me 25. Yes, the stock did go down from 30 to 25, but I have a $5 per share loss, but the stock is now trading at 10. So I avoided that other decline. and I will put it to you at 25, even though the stock's only trading at 10. Now I lose something in that. I have to buy the premium from you for the option, the right. So I sell a put. I say I'm putting it to you. I'm selling a put that says, look, or I'm buying a put to say I'm not selling. I'm buying. I'm buying the right to put the shares to you. All right. Hope that makes sense. So I'm putting it to you because I think the stock's going to go down, or I'm buying an option from you because I think the stock's going to go up. One of those two things. And it's a great strategy, man. I'm a big fan of buying, but I don't do it. I was actually talking to a guy yesterday who's made bank. He's done very well for himself trading. Hit almost 2 million in a simple account. Simple IRA is not even that much older than me. I said, damn. Because a simple IRA, I've never seen. I mean, a lot of dentists used to use simple IRAs, and the most you could put in is like $12,000 here at most, if even that. And the vast majority of people don't have more than $100,000 in simples. So the fact he had well over like almost 2 million, it's like, damn. And he's just trading. He's just trading. He's actively trading, and not. And when I say active, spend an hour or two today. You know what I'm saying? And he likes it. He enjoys. Great guy. Love this guy. Point being is that when I saw that simple, I said, "Man, what are you doing?" And he shared with me he's in option trading. He buys and sells puts and calls, and it's just a good strategy. Now, will it be for everybody? No. I've done stories before how I got smoked in selling covered calls on a dwindling portfolio, which is just done. Anyway, so here's the tail, and I'm not recommending this. I'm just saying, it's something for you to think about for sure. It's interesting to me. Tail invests in a ladder of puts on the U.S. stock market. Remember, putting it to investors to buy it at us at a set price, knowing full well that it could go well below that price. But we're going to buy, we're pairing long positions on the government bonds. So we're going to buy government debt, essentially, assuming that if the market tanks, the government bonds will go spike in value. The portion of the tail is invested in government bonds is engineered to spin off the cash flow from those bonds to help fund the cost of puts. Yeah. As you see, the tail tends to inversely mirror the S&P 500. So let's go see what we got here. I thought this was interesting. Let's see. How long has this been around here? What's the inception date on this guy? He's got 422 million here. All right, so yeah, man. 59 basis points is the fee. So it's only got 5 years or so in this. Premium discount chart. Ooh, see, I do like this stuff. Not gonna lie to you, I find it interesting, but I don't see a chart here. Oh, there we go. Look at that weight discount right here. We're about 6 basis points at premium. That's not that big of a deal. Days at premium 143. Days at discount. That's interesting. Anyway, so if you're trying to protect your downside, this might be a good fund to invest in. You see a fee, 59 basis points. Again, you're not really, number of holdings 21. Look at that. You're not going to make much money. I mean, you could. I'm not. And again, if we go back to Meb's thing here, we see this right here. All right. So going back to 20, this is the market getting smoked in 2020. You can see the tail went way high. This is the market come back and the tail's getting smoked. All right. So you can see what happened here in 2020 when the market got smoked. The tail was up 45%. Yeah, it's giving all that back though, because now we're down 25%. It looks like, and the market is up 35%. So we're getting smoked by the market. There we go. But anyway, the point being is, what do we expect? Do we say expect it to continue to go down or go that way? I have a pretty. I mean, I'm telling you, man, I'm not at all convinced this market isn't. I'm just not convinced. I just think the stuff on the ground is pretty dicey. All right, so let's look at some comments here. We got my man Thomas, big fan. He says investors have lost more money trying to time recessions and crashes than during them. The whole thing about the market timing, and I get it. I don't disagree with that. Time in the market is better than market timing. I want to share with you a couple of things here. My man says, I don't know, and I'm not knocking what anyone else is doing, but I'm staying invested and making my normal once a month contribution. All right, and I get that. So we see I'm making contributions. What's Thomas saying? I'm DCA approaching, dollar cost averaging. You see what's going on here. There's a trend that these guys are following. And here's some market timers, and this is not what I'm trying to say. I start buying when the S&P falls below 4,000. The further it falls, the more aggressive my buying gets. Well, that means you have to have cash to buy, which means you probably missed out on significant gains for the last 13 years. I mean, it's just, I don't like that either. That is market timing, and I don't believe it. But you notice they're buying. You see what I'm saying? Dollar cost averaging buying. My man Sergio, let's see what because he said something else to me. I want to point. January 2020 through February 22, the S&P 500 is up 16%. Is a great time to start a value average strategy. Simply take 50% of the gains. This will drop your 2-year average 8% and make it. Yeah, actually, that's kind of what I was saying in that video. I said take your gains, take some of the gains off the table. I'm still buying because it's cheaper now. I don't need the funds for at least 5 years, 100%. My man Rob says he sees the Ukrainians winning this war. I completely disagree. But here, oh, wait, hold on a second. If you plan to, let's see here. Let's delete this guy because that's just fake news. Remove. That's just, I get these bots from Bitcoin guys. If you're pulling money out of the market to go to cash, I assume your asset allocation was too aggressive to begin with. Nope, not true. Wait until the Fed meets on the 15th. No, I mean, this has been priced in. But there's a couple of videos I want to see. Next election, maybe. You can't do it on the election. That doesn't make sense. Time is your friend, impulse is your enemy. All right, here. Here's my man Sergio. If I'm wrong, didn't you get out of the market in 2008? And if so, when did you decide to get back in? I didn't certainly get out of the market. I got a little bit out, but I'll do another video on why that is. And here's my man Dan, big fan of Dan. Back into the market? Why? Bear market. No one has ever been successful in timing the market, especially twice. Stay the course. Yes, time in the market beats market timing. Yes, 100%. I said, my man, did I say get out of the market? Nope. I said take some of the gains you've had from the last 2 years. That's what I said. And then sarcastically got back at me. It's pretty funny. He said, Heritage Wealth, did I say you did? Nope. Oh, man, it's funny. It just cracks me up. What is it, Josh? All right, right here. All cash and chill, Wellington and chill, VTI and chill. All right, so the point being here is I want to be very precise. If your time is coming where you need to draw down your portfolio, you should take gains. I don't know what else you could possibly make of this. If your time is not coming to draw down your portfolio, then stay out. Stay in, 100%. Notice how everyone's dollar cost averaging. They put money in, put money in, put money in. If retirement is imminent or you're retired, you are no longer dollar cost averaging other than the dividends they're reinvesting. And the dividends reinvesting is great, but that's not going to put enough food on the table. So what you need to do is protect the downside. This is the thing that people got to understand. Downside risk protection is more important than upside capture if you're about to retire or are retired. These two things are not mutually exclusive, i.e. downside risk protection and staying in the market. I am mostly in the market. I have some money in Wellington. That's still in the market, for heaven's sake. I'm still adding to it. I'm still adding. But if I'm about to retire, I'm taking the gains and protecting it. Just because the market always has come back, doesn't mean it will. On top of it, there's a lot of sleep that can be lost while you're waiting for it to come back. And secondly, if you're pulling money out of the market, you could be shooting yourself in the foot, which is the point to have cash. So take some gains and put it into cash. All right. Love to hear your thoughts. We'll see you.